So welcome back to Macro Insight. Today is the 2nd of March, and let's take a look at these markets. Markets closed on their lows last week as yields reached as high as 156 on the 10-year on Thursday, intraday. Obviously, the growth stocks have been battered, but even some of the other sectors took a bit of a breather as that risk-off tone kind of kicked in across the whole market by Friday. So up until Friday, you'd had energy and financial stocks were kind of resilient and immune to the sell-off, let's say, because they actually tend to like the yield curve steepening and rates higher sort of scenario. But even on Friday, you saw the growth stocks kind of stopped going down, but some of those other sectors got hit, right? So that's why the market was quite heavy, and we saw those 3,800-ish kind of levels. Now, the market did try an intraday bounce at 38.50, but then got sold off into the last 15 minutes. And that very much looked like month-end selling, right? So generally you have a lot of funds that rebalance at month-end. And given that you'd had a rising equity market and you'd had a bond market that was selling off hard, then the month-end flows were going to be to buy back bonds and sell some equities. So that was no major surprise that market on close order to sell kind of took the market back down about 50 points, right? And that also is probably what helped stabilize bonds, that month-end buying that took that bond yield from about 156 back to around about 140, right? So what have we had over the weekend? We've had a nice recovery over the weekend as those yields sort of cooled off back to 145 as we speak, I think they are. A bit of month-end rebalancing we mentioned. And, things did feel quite oversold in the short term, right? So if we have a look at some of the charts, let me share my screen. I had been sort of marking out a few levels of support on the S&P. We've pretty much got to all of them. And, as I like to see, if we're making those new lows in price, but we're not making new lows in the momentum indicator, that to me is a bullish divergence signal. And if it's happening in the vicinity of some key support levels, which are my blue lines that I marked out, then that makes me think. And then last factor is we're at the lower end of the Bollinger bands, then you're ticking a lot of boxes to suggest that some sort of bounce is imminent, basically, right? So those for me were the things on the S&P, thinking, we've had the sell-off, people have been a bit spooked, people have kind of rebalanced some of their portfolios, taken some risk off the table, so now the market's kind of, going to most likely have some sort of bounce, right? Now, does that mean we're going straight back to the highs? $1 million question. Who knows? We'll talk a bit more about what I think, but I think fairly likely. If yields remain stable, then we probably do continue kind of grinding back up towards those highs. One thing to keep an eye on to give you a sense for how the market is feeling is the VIX. So you had VIX kind of in one day getting from 23 all the way up towards 30, and that's got smashed back down basically, right? So this is like a 4-hour chart on the VIX. So it didn't take very long. So when you see the VIX collapsing so quickly post-spike, that kind of gives you a bit of a feel for where the market is at in terms of, how comfortable the market is again, basically, right? So I think the fact that VIX has collapsed so quickly gives me a little bit of comfort that in the short term, we've probably had our little correction, and over the next week or two, we are likely to kind of continue eking out some more upside, because that VIX hasn't stayed particularly elevated, basically, right? Now, that's kind of the good news. Asia, though, right? So if you look at China, that's starting to get a little bit concerning, right? So you had China manufacturing that came out weaker than expected, right? So it still came out above 50, but it was weaker than expected. And it's this kind of the first real disappointment we've seen probably, in a good 6 months, let's say. So, and then you've also had China saying, they're worried about overseas bubbles and the risks in the Chinese property sector. So given that China led the recovery last year, if we continue to see them disappoint over coming months, then for me, that would be a bit of a red flag, right? Red flag for the global recovery narrative. especially a red flag for the commodities. I'll talk a bit more about that later. But, you know, I think it's something to keep an eye on. So keep an eye on China indices like the HSCEI. You know, it's got this level here around 11,200. If that starts to break down, then that would signal, you know, something to kind of be a little bit wary of, I'd say, right? So that's China. And like I say, that was very much leading the recovery last year. Now, India, on the flip side, is still looking okay, right? You know, India's been charging super strong uptrend here. I've been waiting for dips to buy. I managed to get some on, so I'm happy. But, you know, let's see how that plays out, right? So for now, if we continue with the reflation narrative and the dollar does resume its weakness and the global growth continues across the world as vaccines get rolled out, then this story should continue playing. I like India as a long-term play on the long side because it's got positive demographics, positive growth trajectory. You know, it seems to do well from that weaker dollar narrative, and the trend is just very, very strong there, basically, right? So I like that longer term. I'm glad I managed to pick up some of that on the dip. But flip side of that is just keep an eye on China, because if China has a wobble, then it probably means the rest of the world isn't really immune, okay? Europe in particular tends to be quite dependent on Chinese growth. You know, the export sector in Germany, you know, is linked to that. If we look at the charts in Europe, for example, the DAX, you know, it looks all right, the chart, right? The chart here suggests to me that we are forming this sort of triangle where you've got lower, you've got ascending kind of lows, you've got this horizontal resistance level. If we take out 14.2 on the DAX, then the DAX easily got a rally in it, basically, right? So Europe, hopefully Europe should be okay. This reflation story continues. Problem with Europe, like I say, it is a bit dependent on China, and also the vaccine rollout in Europe is not going amazingly well. Okay, so I heard that whilst, you know, the UK is planning to be pretty much back to normal by June, there's a chance that Europe isn't back to normal until middle of next year, right? Which would be a disaster for Europe, right? So I mean, if that really is how slow the vaccine rollout's going in Europe, then it's going to be hard for Europe to kind of get back to, you know, a normal economy, and that's going to be a drag on European growth, yeah, and likely a drag on European markets. So that's something to kind of pay attention to in Europe. But like I've said many a time, if I'm going to get long risk and I'm going to get long equities, I've got very little interest in buying Europe. I'd rather buy the US, just because the price action in the US, the resilience that that market shows time and time again, it always bounces back much, much faster. If you're going to buy a dip, you want to buy a dip in things that recover quickly. So you're generally going to want to buy the US market, or you're going to want to buy things like India that are showing you very, very strong uptrends. Okay. So, you know, looking more closely at the charts in terms of levels on the S&P. So yeah, we got down just below 38. We're already back to 3,900. For me, the obvious target on the upside is around 4,000 on the S&P. I don't really see why that isn't achievable within the next sort of 2 or 3 weeks. That would kind of be my time frame if we continue to see yields stabilize. If you want to have a look at what yields we're doing, let's quickly bring up the 10-year chart. So here we've got yields, obviously they motored up to 156, kind of pulled back to about 138, and now we're stable, right? That's what we want to see. We want to see some stability. If we can get yields to stay in the kind of 140 to 150 range over the next couple of weeks, it's probably very, very bullish for the market. And you're likely to probably see a lot of those tech names that were beaten down have a bit of a recovery, right? And that will drive the market higher, most likely, okay? Right, so that's kind of where we are and what's kind of been happening. In terms of what's coming out this week, we've had some ISM manufacturing data in the US come out positively. We've got a bunch of Fed speakers, I think today and maybe tomorrow. We've got UK budget on Wednesday, so that might have some impacts for the sterling. But generally, I don't think it'll be that market moving. You've got the US Senate to vote on the 1.9 trillion relief package. That's Wednesday again. Wednesday, Thursday, they start talking. You've got an OPEC meeting on Thursday, which may well move oil. So if we have a look at the oil market, finally, oil has a bit of a pullback in line with some of the other commodities, but that pullback doesn't seem to be lasting long. Very, very strong uptrend in oil recently, but it's done the minimum requirements. It's got back to its kind of 20-day average on the dailies, and it's staging a relatively nice bounce off there, right? So no reason to think this oil rally isn't going to continue over the sort of medium term. It needed a bit of a pullback, and it had about the $3 pullback, right? $3 or $4 pullback, which is more than enough, really, right? And then you've got Powell discussing the economy. Maybe, you know, the market's kind of questioning where does the Fed step in to cap yields if yields continue to go higher. So you've got Powell speaking on Thursday. So market will be looking for any hints from him, particularly if the market sells off into that. He'll probably be under a bit more pressure to kind of appease the market and tell the market where the Fed's going to step in and cap yields, if at all. But that's kind of, you know, remains to be seen. At the moment, the market's pretty comfortable from that over weekend bounce. So there might not be a lot to say, right? Okay, so that's kind of my thoughts on equities and the kind of news flow to expect this week, right? So the dollar, obviously, as usual, kind of everyone's got their eye on the dollar. So we've been, you know, it's been holding up pretty well, the dollar. You know, some people might say, is that because yields have rallied so much in the US relative to other places? Generally, as I explained last week, it tends to be the short end of the curve that drives that FX flow. And actually, you know what, the 2-year and 5-year parts of the curve did have a bounce in yields. So maybe that at the start, when it was more the long end moving and you were seeing yield curve steepening, that wasn't really necessarily driving FX. But I think, yeah, the front end did have a bit of a catch up. And I think that probably did help support the dollar, right? But if those yields do stabilize, which they look to be doing, if you look at this chart on the dollar, you know, that momentum indicator there, we're kind of approaching that 91, 91.5 area again with slightly weaker momentum. If you look at some of the shorter term metrics, the same story, like this 4-hour chart would suggest this dollar rally is on pretty weak momentum there, right? You're seeing lower momentum peaks versus higher price peaks. So for me, I think the dollar is very much at risk of rolling over. 91 seems to be quite an important level. You know, if it takes out 91, could easily slide back towards that 90 area. If that happens, what do you expect risk assets to do, right? Dollar weaker, probably going to get a bounce across most risk assets, particularly commodities, right? And we'll talk a bit about commodities in a minute. What else in FX land? So I have been advocating being long Aussie dollar as a way of playing weaker dollar and long commodities trade. That's had a big correction. I mean, it had a great rally from when I recommended it. It's had a big correction. Why was that? That's because the RBA stepped in and started buying a load of bonds and saying that they were going to control their yields and not let their yields go higher. So that was the reason. That was kind of a little bit of a surprise how aggressive they were in their bond market. But then they have overnight kind of, you know, left rates unchanged, and then we've had a bit of a move back the other way in their yields. And as you can see, we've had a bounce in the Aussie as well. Longer term, I just think if the reflation trade continues, commodity trends continue higher, economy globally kind of continues to heal, then I think the Aussie still got legs to the upside, and I'd still be looking for well above 0.8, maybe up to 0.82 or even 0.85 over the next 6 months. I do think it needs to be a longer term trade. I wouldn't go too short dated on that. So like the way I'm playing it, as you all know, is I'm long some 6-month calls in the Aussie to just sort of let that trend play out. That's kind of where we are on Aussie. And then if you look at euro and sterling, you know, they're also signaling, just like I think dollars at risk of selling off. These are signaling potentially buy signals. So if you look at the euro 4-hour chart, we've made lower levels there. We touched around 112 on a bullish divergence with momentum ticking up. So it looks like that's showing signs of a potential short-term bottom. Same story in the pound. We've got lower lows there with higher momentum. I mean, that pound had a big old move back down from 142 to 139. I mean, it was pretty brutal. But, you know, I think if the dollar does roll over, then that pound's heading back towards that sort of 141, 142 level, most likely, right? So I think those are just mirror images of the DXY as they tend to be. I think the market is now very aware of the UK doing well on the vaccine front. I think part of this sort of strength in the sterling over the last couple of months has been that being priced in. So at the margin, do I think the vaccine news is going to move pound that much in the short term? Probably not, because now it's not a major surprise, right? We've had Boris tell us that we should be back to life by June. Hopefully he delivers on that promise. But you know, if things continue to go down that trajectory, then there's no reason for the pound to really do anything that significant, right? I mean, obviously, once we see some growth data come back and we actually get some GDP data and some real sort of hard data showing that, yes, the economy is booming and we are back to work and we are back to going out and all that stuff, then yeah, you might get another sort of up leg in the pound relative to other things. But I think we need to wait for that data to come through. So with the commodities theme, I think it's like long term. I like commodities as a theme, and I like it as an asset allocation, right? So for me, dips in commodities due to dollar strength are giving me an opportunity to allocate into commodities. So I don't really put short-term stops on my commodities. I tend to say, right, I'm just going to pick up clips of commodities and we'll try and diversify that risk, right? So what have I been buying? I've been picking up corn. I've got some bids on wheat. Obviously, I picked up some rare earths, some uranium, things like that a while back. I picked up some Freeport McMoran, which is a copper miner. Last time it got quite low. So things like that. It's like my shopping basket is full of commodities, and I will use dips and weakness in commodities to get into that. Now, the one thing that's going to derail that view is going to be if China has a big wobble, right, and has a big problem, right? So I'm going to share a chart with you that I saw Nordea Bank put up, okay? So this chart, so this is a Bloomberg Commodity Index, and it's got China's credit impulse 12 months, the change in China's credit impulse, okay? Now, that's basically just kind of giving you a flavor of what drives these big commodity cycles, basically, right? So you can see that China's credit impulse kind of rolled over a little bit recently. And that's probably why we're seeing, you know, Chinese equity markets stalling as well. You know, China talking about their concerns about bubbles, about property market, stuff like that. So now if this really marks a top in the China credit impulse and we do roll over, commodities probably don't escape that, right? So commodities probably have a problem, right? But commodities have got some decent drivers longer term, right? They've got the general dollar weakness that is expected over time, okay, because of what the Fed is doing and all the fiscal that's now coming through and likely to continue. You've got the infrastructure spending globally that is required, right? And that's helping commodities. And then you've got supply chain problems, supply bottlenecks, where you haven't had the capex that you needed in certain sectors like copper and stuff like that. So you've got a lot of fundamentals that are supportive, but the market's ripped, right? Commodities have ripped hard since last summer. So for us to see a pullback in commodities is very, very possible. Yeah. I mean, when you see parabolic moves like we've had in copper, it does make you a little bit concerned, right? So, I mean, I don't, you know, I like copper, but I don't like chasing parabolic moves. So if I bring up the copper chart, right? I mean, that move from sort of February 17th up to February 24th, that was parabolic. So, you know, we had a nice uptrend, nice steady uptrend, and then it just went parabolic, okay? So we don't like these parabolic blow-offs, right? Because they make us nervous that things aren't sustainable. So I drew, you know, when we had that blow-off, I was looking for potential retracement levels where copper could pull back to get back in. You know, I've marked out a few levels. Whether or not it pulls back and gets there, who knows? But, you know, I don't feel like chasing copper right now. I'd rather like to see it correct a bit. take some of the froth out, and then it can carry on, right? Because you'd rather be in a healthy trend that's going up at a rate that can be sustainable rather than getting into these parabolic crazy moves. Okay, so that's kind of what we're hoping for, but we'll see. Like I say, I have already dipped my toes in copper via that mining stock, but we'll see. You know, like I say, I'm not chasing it and rushing to buy more right now. Okay, then gold, right? Speaking of commodities, let's have a look at gold. Obviously, that's been my big call for the last few weeks. It was basically a real yield play. We've been going on about it. Why was it rallying in the face of real yields doing what they were doing? Here's a chart, you know, going back a couple of years. You got US 10-year real yield inversed. You've got the gold price, and they kind of track each other pretty well, right? And you had that. You basically had those real yields kind of rising from around -1 to nearly -0.5. And gold's kind of coming down on the back of that. And now, actually, the real yield spike recently has been a bit sharper than what gold has done. So gold was kind of you could argue that gold was pricing in that real yields are going higher, okay? And now real yields are confirming that by actually going higher, right? So you could argue that these two things have kind of caught up with each other now, okay? But if you think real yields continue to rise, because we are in that, you know, environment where you are having growth improving, and you think kind of the nominal yields are going to outpace inflation, so real yields will continue to go up, then gold will continue to do what it's doing, right, and slide. Now, personally, I don't think gold's got massive downside now. Like I say, for me, the target was 1670. I did think that 1760 level was clearly going to break, and it has. Now I'd expect that level to actually act as some sort of resistance. Where are we? So we had this big support level at sort of 1760. There's this chart here. And it's been broken. It kind of did act as a resistance, and then it's come off again. For me, that big target of 1670 is probably where I would cover all shorts. I've already started covering some shorts on gold. And then I may even do some, depending on where yields are and what I'm thinking on real yields and things like that, then I'd probably think about doing some more longer term purchases for gold, because I have lightened up, like I said, on my longer term portfolio for gold. But around that 1670 level, I'd be looking for, you know, for the market to be around there, and I'd be looking to see where real yields are, see if real yields have done enough. I mean, if real yields get back to zero, yeah, I'd expect the Fed to be very, very interested to kind of maybe stop that from going much further, right? And the only way the Fed can kind of do that is if they start talking about yield curve control and stuff like that. So, you know, that would be pretty good for gold if they started talking about yield curve control and things. So, you know, that's what I'm looking for. And like I said, I've played the tactical move down. I played that break of 1760. Now I'm slowly starting to take profits on things, but just running a few 1700 puts still in case we get that thrust lower to 1670, and then I'll just take them all off. But I have full disclosure, I've taken off, I was putting delta shorts on up near 1800. I took all of those off quite early at 1760. I was putting the 1750 puts and the 1700 puts on to March. I've taken all my 1750s off, and now I'm just left with my 1700 puts, basically. I'm going to keep those until I see that 1670 area or somewhere in that vicinity before I take any of those off, basically. That's the game plan on gold, right? But because we have seen some bullish divergence in the shorter term, that's what kind of triggered me to take off some of these gold shorts, right? So if you look at the 4-hour chart on gold, it's kind of got these lower spot levels from 1720 back down to 1708-ish, and the momentum indicator is ticking up, basically, right? So for me, that's signaling maybe gold bounces, maybe it tries to get back to that 1760 level. And who knows, if it gets back there and I fancy it, I might put some shorts on again, right? If I think that 1760 now acts as a resistance level, then that might be, you know, the fact that I've taken some profit already, that gives me bullets to maybe resell it and play that as a bit of a resistance on gold. for that next leg down, which I kind of think is in progress still. Okay, so that's kind of how I'm looking at it. Thanks so much for watching, guys. If you enjoyed this video, then we'd love to have you join our Macro Insight community. Just visit www.options-insight.com and sign up for your free trial to our live and interactive weekly macro call. If you haven't already done so, please subscribe to our YouTube channel. You'll find more market updates, class highlights from our Summer Academy, and also video tutorials on anything from options basics to market making fundamentals. You can also connect with me directly. I'm on LinkedIn, Twitter, Facebook, Instagram. You can follow me on any of those platforms. Or alternatively, feel free to send an email to inquiries@options-insight.com. Thanks a lot.